Happy Financial Fitness Friday. Hope everybody's having a good week. Quickly go to the disclaimer. Okay, this is meant to be, it's that this is educational in purpose, and none of this is actual recommendations, or it should be taken as specific advice. It's while you're doing the poll, I saw this picture about Pi Day. That was pretty, it's like a stupid dad joke, but I thought it was pretty funny.
How do you sell math?
Brian, that's why it's funny. Okay, I'm going to end the poll. Okay, first question, do you have umbrella insurance? 4 out of 10, it's a little slight improvement from last time. Said yes. Half. Okay, still 60% said no, or what the heck is umbrella insurance? So we'll cover that as well. That's something I said last week. It's so important and it's so cheap. It's a liability coverage for your home, renter's insurance, and auto, and it prevents you in case of kind of like negligence. Any, like you hear about somebody trips at your house, or you get in a car accident, it's your fault. When they go and sue you, it protects your assets, and it costs like $150 to $300 a year for like $1 million of coverage. So, anyway, it's so important to get, and it just, but we'll talk more about that. Okay, if you're not retired military, do you have a high deductible health plan? 2 out of 9 said yes. I think I need to add another one. And some people don't, like if you have kids, but if you're young and don't go to the doctor very much, it's a great way to get a health savings account. It's like the best, retirement savings plan there is. And so some people, even the kids are grown, whatever, you still you can handle the high deductible. It might be worth it. But we can delve into the HSA as well. But it's a quadruple tax advantaged account. Basically, should be considered as a retirement savings account. Third question: what should be the basis for coverage of the amount of umbrella insurance? Yep, 6 out of 10. Hopefully, some of the people remember that from last time. If they didn't already know, it should be based on your net worth, not the assets you own, because the assets you own, you could be owed money on those, which doesn't really matter. But it's really your net worth. So your total assets minus your liabilities is what you want as coverage. That way, if somebody comes after you, sued, your entire net worth is covered, and you won't lose anything. And so it's something you want to check. As years go by and your net worth goes up, you need to update your umbrella policy for larger amounts. Okay, when was the last time you checked your liability coverage amount? These are such small minimums. It's like 15, 35, you get in an accident, a doctor's bill is going to wipe out those minimums quickly. And that's why umbrella insurance becomes so important. When was the last time you checked these? Last time policy renewed 40%. A year ago, 20% when I initially set it up. I expected more people to say that, because typically you just go renew your policy. I think you just go renew your policy. Like, did it go up, and why if it went up, when, I'm only getting older and driving better. But homeowners insurance has been going up consistently, especially in California. It's really frustrating. And a lot of people aren't even being able to get insured. There's only certain insurance carriers. 5, do you have life insurance outside of employer-provided group life insurance? Good. 7 out of 10 said yes. 3 out of 10 said no. That's what we'll delve into later. And some people might not need insurance. We'll see. What type of insurance do you have? 5 out of 10 it said term. 1 out of 10 permanent. 1 out of 10 universal life, and 2 out of 10 don't know. Or 1 out of 10 has none. 2 out of 10 has none, and they don't know what kind they have is 1. Okay, we'll delve into each of those different types, and that's something important to understand of what your insurance is, definitely. How often do you calculate your never? How often you calculate your net worth? Never done it. Half of the people. Okay, that's something I want to change as well. And I've got a free like net worth, tool, like an Excel sheet that you just plug in the numbers and it provides it. But 1 out of 10 does it annually. 4 out of 10 do it quarterly. I do it quarterly. I think monthly is too much. You're like, it doesn't make sense. You're just wasting time, I think. But I like to do it quarterly and tracking your net worth, even if you're like really young and you say even had a negative net worth, like say somebody has a lot of student loans, it's by tracking it and seeing it change positively, it's motivating, and I think it helps improve behavior. You know what I mean? It helps you save more and invest more as you see those numbers growing, and it's pretty exciting. So it's something I recommend you do. And I've got the template of you'll see one of the last slides of what it actually is. Let's see what else. The other questions: do you have an IRA? Roth IRA 30%, traditional IRA 10%, 50% have both. Good. And Coach 5. I don't know if I had that in there. I'm not sure who. I guess that's no. But I think both. Most people need both because there's income limits on. I'm a big fan of the Roth IRA, the deferred tax-free growth, but there's income limits on it, and so in order to fund you can fund a Roth IRA though using a traditional IRA and doing a backdoor Roth IRA conversion, which we'll go into for anybody that wants to. I've got those slides as well in backup. Whoops, sorry. And last two: do you max fund your IRA annually? 40% said yes, 60% said no. Okay, that's something hopefully we can change as well. I know you do what you can, but in terms of hierarchy of saving and investing, for me, it's you get that full match on the 401k because that's free money. Then if like for us, advise that the ESPP, I maxed that out too, like 5%, because that's free money too. That's a easy 15% gain. And that you could sell right away and fund your Roth IRA. But once you get that match on the 401k and the ESPP, then fund your Roth fully and your HSA, because there's more flexibility and better investment choices you can make in. And then if you got that and you have additional money, then go back. I like some in brokerage so that it's not all tied to retirement accounts, because but that, and hopefully you can get a good brokerage account and then go back and try to max fund your 401k. But that's kind of the order in which I do recommend. I'm sorry, I'm not recommending anything that I do that I think is wise. Okay. And the contribution limits for this year are $7,000 for the IRA, $23,000 for the 401k, and if you're the year you turn 50 and over, for the 401k, it's additional $7,500, and for the IRA, an additional $1,000 you can put in. If you don't already max the 401k, not talking the match, but the actually maxing out that 23k, do you set up auto increase? 20% said yes, 40% said no, and a good 40% said no max fund already annually. So that's good. But it is good to just set up an auto increase. We get raises, right? So an easy way, just set that up. You won't miss 1 more percent or even 2%. So I would do it probably personally, maybe every 6 months, set it up and just see, because it's not going to be that significant. And then if you just get, I'm a big fan of paying yourself first and then living off the rest. So, okay, any questions about those? Okay, well, stop sharing that. And okay, here's just the quick agenda. Like I said, I've listed what we had on part 1. We'll go back over umbrella insurance just at the end because that's so important, and like 40% of people don't have it. But we'll talk about life insurance, and since there's a decent number of vets, we'll quickly go over SGLI, VGLI, that kind of stuff too, and survivor benefit plan. Okay. Why do we purchase? Why do you want life insurance? Is it an investment? With
To take care of your family.
take care of your family. Yep, it's for protection. It's in case of a a tragic loss. That's what insurance is for in general. The it's I remember hearing somebody say that like mixing life insurance with investments is like having a dishwasher in your car. It just doesn't make sense. You don't need a dishwasher in your car. But I thought that was funny. But it's not an investment, and that's what too often, I think insurance salesmen try to say, and they try because why? Because that's where they make their money. That's what ultimately. And be skeptical about cash value whole life insurance rates of return. They use words like guarantee, 7%, and it's not true. They show you these beautiful graphs, but it's really just not true. Consumer Reports did a report a while back, and they found the average actually rate of return on the cash value portion was like 1.5 to 2%. That's terrible. That's not even near inflation. So be skeptical. And in general, I don't think most people need whole life insurance. Term, that's the difference until you insure yourself when you're financially independent. Okay, primary replacement, Matthews, you said income replacement to support and insured dependence. Income for the readjustment period after someone passed away, maybe whatever for the kids that you need, and then other things like mortgage, income for the surviving spouse for the rest of her life. So that's really what insurance is for. What if nobody if you don't have any dependents and nobody depends on your income, do you need life insurance? What do you guys think? Is there a reason to get it?
I don't think so.
Okay. Anybody else? How about if you're young and not married yet? Or what if you're engaged?
So typically, the younger you are, Alan, I think the better rate you're going to get on insurance. So it might be beneficial to get insurance early on if you plan on getting married. I don't know.
Yep, if you're planning on getting married, and you never like. Here's the thing. This is a terrible example, but think of how many people are getting colon cancer early. The one thing, like I'd say, yeah, you don't need insurance, just like you said, John, and you don't really. But what you don't want to have happen is, and like Omar said, but you can get term insurance super cheap for like 30 years, or whatever when you're very young, and it's it's like $25, $30 a month. It's really insignificant. What you could get, but what you don't want is to get a medically disqualifying something in the future when you really need insurance. So it's just a consideration. I'm not saying people should get it if they don't have any, but it's something to think about at least, and especially if you're in a relationship, where you're likely to have dependents, like a fiance or something like that in the road. So anyway, just something to think about. Okay. Here's this is a bias set. What we have is our free term life insurance. If you were to pass away, it's up to 3 times your income, up to 750K. I believe if you actually died on the job, it's like 10 times your salary. I'll have to look at that though. But then there's some things change as you get older. But it's also nice if you're terminally ill, you could cash out up to 75% of this benefit. And then you can convert this if you wanted to. I think most people just go to Policy Genius or something and get a good quote. I know Navy Federal, Navy Mutual Life Insurance, they do. They get competitive rates for military compared to others. But I consider this bonus insurance. I wouldn't count this towards what you actually life insurance needs are, because you never, you're not going to stay at Viasat forever, that company forever. So it's something I think that's just a nice plus up at the time. But I wouldn't consider it really your insurance, because who knows, you get laid off. So, I mean, it's just not, it's not your policy that'll stay around forever. Okay, SGLI and VGLI, they've upped this to 500K. Recently, it used to be just 400K. Pretty cheap. It's 6 cents per 100, and the coverage on SGLI ends after 120 days separation from service. But you can convert to VGLI, which is not really, it's a really, I think of it as expensive term insurance, because we'll go through the rates. But VGLI is good for people that have an underlying health condition they know of, because they can get that insurance with no proof of good health within 240 days, which other places, they're going to do a screening, et cetera, where, you might not be insurable already, but you could. But VGLI is super expensive because the premiums go up every 5 years. And we'll quickly show that. And you can convert it to a commercial whole life policy without the need to provide evidence of good health. That's good to know. But like I said, I'm not a big fan in general of whole life insurance if you don't need it. If you have special needs children, there's certain cases where whole life makes sense. For the vast majority, I think term and invest, you get term insurance and invest the difference is much better. Here's the cost of VGLI though. Look at how much these go up as you enter, into your 60s and 70s and 80s. I mean, those are premiums per month. I don't think people are looking at that when they get out of the military and sign up for VGLI. It's just they do what's the stupid, and our TAPs, our transition courses don't help us very well and really teach us, tell us smart things to do, unfortunately. So, okay.
So, Alan,
Yep.
would VGLI make sense? So I actually just submitted my application for it yesterday. I'm 32 years old. Does it make sense to hold on to this for the first 10, 15 years while the premiums are relatively low per month, and then convert it once they do start to spike up?
What I would do, pal, I'd go check out Navy Mutual, and then check with go to Policy Genius as well, and see what they are. At your age, you're probably going to be paying. Let me go back one. You can probably get a. And we'll go into it, because I'll show a couple different examples of term. But you'd be paying probably about the same as you would with VGLI right now. But you could get that on a flat, for 30 years or something. So that's probably that's better. VGLI I just don't think it's good. I think it's good if you have a health concern that you're not going to be insurable otherwise.
Gotcha.
But
another example of that, Alan, is like I got a term policy when I was retiring from USAA, and then I rolled my SGLI into you have to make sure that you've got the availability in your policy that you're buying to do that. But it was a fixed rate, like you said, for the indefinite 30-year term. But then I was able to roll the 500,000 SGLI into it without an additional health screening and stuff like that. So
that's nice.
Super easy.
Yep. No, that's great. And then survivor benefit plan. I don't know if you guys are familiar with that. This is, really, but for retirees, it's kind of automatic at 55% unless you change it. And then what this gives your dependent or dependents up to 55% of your base, your retired pay as an annuity if you pass away. It's pretty expensive, relatively speaking, but it depends. It's, should we do this? Maybe. I mean, it depends on your situation. What do it's 6.5% of your base amount, depending on how much you choose, from 10% up to 55%. The spouse has to sign off if you don't want survivor benefit plan. So if you want to go with a term life insurance instead, that's less costly than this, they have to sign off. But this would give them an annuity up to a certain, if you passed away as the service, the retired service member. But but it is paid up. This is paid up after 30 years and at least 7 years old. So the guys that people that went in the military at 18 and got out at 38, they're going to pay on for 32 years, you know, because they're not 70 yet. But it's like paying a whole life policy in 30 years. That makes sense. Here I just ran some numbers for a few different scenarios. You know, an E7. Here's what their retirement pay would be, how much their premium would be. You know, they're not. You know, you look at the 06. Those aren't cheap premiums. Those are more expensive than you'd pay for definitely a lot more than term. So is this the right answer? It depends. How's your health? You know, what's your longevity in your family versus your spouse? You know, what's your current financial situation? You know, insurance. That always comes into play, because if you're already financially independent without that money, it doesn't make sense. And then comparing against other insurance is something. It should be. Sadly, it's just not consideration often. So how much life insurance is needed? There's a couple different ways. Have you guys heard of this? Like 10 times your income. I've heard that even on podcasts and stuff, but it's not really. I don't know. What's that based on? I guess it's better than nothing, but I mean it's but here's the typical 3 real approaches from financial planning that they use. The human life value approach, and we'll go through an example of each of these because I'm a dork and I figured you guys would like to see the actual calculation. But the needs approach, I like the first 2, but the best, and it kind of depends probably on the situation, which one would make more sense. And then the capitalized earnings, kind of like using the human life value, but not counting a certain life expectancy. But we'll go through. Here's like, and as you're getting closer to financial freedom, then in your financial independence, then I think the needs approach makes much more sense. It's much more simple. Like, okay, what do you need to pay off? What debts, to clear, clear so that your family's good to go and they've got the rest of your money to live on. Okay, so human life calculation report, you figure out, just say a single breadwinner, or actually it doesn't even matter, but what your contribution is as one person. Then you subtract out what your expenses and taxes are, how many years you plan to work. So like Kyle, you're talking about, you said, 30-year term. I don't think, maybe you plan to just work 20 more years and retire early, so that's the number you'd use there. But then you calculate your future value of the lost earnings for the value for the family, and then go back to the present value today, and that's what your policy would be based on. So here we'll give an example where Diane supports Jack. He's age 40, earns 100K, 50K after taxes and expenses that are left. So plans to work 20 more years and retire at 60, assuming a 4% raise per year. The future value, FV, is nearly 1.5 million. Now, if you discount that back to present value at 4%, that's $680,000. Policies go into typically 500K, 750K, a million, and in breaks like that, you don't get a 680K policy. So in this case, you'd want to get actually not 750 million, 750K. Wow. That's a bad typo. 0.75.
Yeah, what's the premium on that plan?
But you'd want to get 750K policy there. And then this is a calculation. There's software to figure this stuff out, but in all this stuff, and if you go to a financial planner period, you need to have skin in the game. You're not giving up this stuff to them. You know what I mean? A financial planner should be like a guide, a quarterback. But you don't just trust them with everything. You got to have skin. Okay, here's the needs approach, which I like in most cases. But this is okay. What do they need if somebody if I just passed away? Okay, final expenses, like the burial, medical care, adjustment period, debt, get rid of the house payment, any cars, any debts. Hey, kids are young. how much is it going to cost for their school, and then just you can see all these things. So we'll go to a calculation. So assuming funerals 20K, medical, the spinal medical bill 20K, probate, that's probably a low estimate, but I remember seeing these numbers when I was doing this studies in the PFP. But it made for an easy number, 50K right out. But you sum all these up, comes out to 1.8 million. So that's what you probably get a $2 million policy in this case. So because once again, it doesn't go to 1.8K. Capitalized earnings approach. This is kind of like I said, the human life, but it doesn't determine a work life expectancy like the last one had a year. It just uses as presumed in long-term investment rate returns. So here's the example thing with Diane from previously. The formula goes like this. You got earnings, same thing, earnings minus what goes away in expenses and taxes, and then your denominator is an inflation adjusted rate of return. So it comes out to about the same in this case of 2.07 million as the last one. Any questions here? Okay, here's the different kinds of insurance: term, universal, and whole life. Universal is the most confusing one, and probably the one I'd stay away from both. So term in general, it is a term. It's cheap because the point is you're probably hopefully not going to use it. You're using this insurance until you can self-insure, and that's why it's cheaper. Because the other ones, like whole life, you're paying for that whole premium, and so for that whole death benefit. So it's going to be more expensive because they're going to pay out assuming you keep paying the premiums. The 95 to 98% of policies lapse in term. Insurance agents will tell you that why would you get term when you're just throwing money away? And that's the way they get people on whole life insurance. Like, yeah, why am I spending all this money? Well, you know what? I pay homeowners insurance too, but I don't want my house to burn down just because I'm paying insurance. Insurance is for protection. Use your investment to fund, to invest. Not, not a big fan of the cash value. But term is, like I said, for the vast majority, term is right. I think the best answer because it's cheap and allows you to fund all your investment accounts and really become financially independent. Whole life, it's lifetime protection if the premiums are paid. What I don't know, and I don't think insurance will find, is how many people actually lapse in their payment of premiums. And then think about it when people get old, unless it's on automatic, and who knows. But they're not going to mind if you stop paying and then lose your policy. So I would be curious though how many people lose out, and don't pay their premiums all the time. And there's a certain, period, I think 60 days or so, where you're okay, but it's scary. It is whole life though, I do think is good. So if you have special needs children, that's definitely something you probably need. And then if you've maxed out all your tax advantage accounts, you have the flush brokerage account, and you're still looking for some kind of tax haven, then it might be a good idea. So because there's some benefits of that cash value that you can use, but to me that's only because you're already so buka rich. You're just looking for a tax haven. But this is, in general, by term, that's the difference until it's self-insured. Okay, let's go. Kyle, this goes into kind of the different ways of doing term. And most people have a level term. So if you paid, like VGLI is not a level term. So it goes rising. It's the annual renewable. It's every 5 years. That's why it goes up so significantly as you get people age. Most people have level term. I like the idea. And if you say, Kyle, you had more dependence down the road and you realize I need more life insurance, you can tack on additional terms. And what you could do then, though, is might be going, over time, my mortgage is going to get paid off. This is going to go away. Kids and school is going to get paid for. So I like this idea of a decreasing term, because as time goes, years go on, your debts go down. You need less insurance. So that's something to consider. Insurance companies don't talk about it very much, but it might be a way to get a more affordable, a larger amount initially for the same relatively cheap price, but then have it lower as time goes on when you don't need as much insurance. Any questions on here? So term, no cash value. It's just you pass away during the term, they get the face value, whatever the policy, let's say like this case, $1 million. But if you die after the term's up and you didn't renew, zero, nothing happened. You don't get anything. Okay. Oh yeah, and this is what I was saying. You can stack level term policies over time. So, okay, the other types of whole life insurance. This is whole life, the permanent, not universal, which we'll go into the next one. Ordinary limited pay, which limited pay is kind of cool. Like if you had the money, they could pay it off sooner. And then variable life, which is another cash values invested. I put that in quotation marks because it's not exactly really invested typically. It's in something, you don't get dividends, you don't get all sorts of things. It's not like you could really pull out that stock. It's not really invested. And then we'll go into universal next, which is like term policy, but with a cash value. And there's different kinds of these, but it's kind of confusing, and it's probably something to stay away from, I would think. Annual mortality and expenses increasing. So unlike like whole life or the level term, these will go up. There's one option is option A, which has, these are unbundled. So you can have the cash value separate from the death benefit, which the people get that death benefit at the end. But the cash value could change, depends on how it's invested. I just get term and invest it for real, in my opinion. But okay, option B, both of these, the person gets both the death benefit and the cash value, but it's more expensive because of that. They're going to pay out more money ultimately. And then there's variable life. This is the one that's probably definitely, I put in red, beware of indexed universal life. That's the one where you hear people talk about, oh, market participation with no downside risk. That's just don't believe it. I mean, there's all sorts of ways you're capped at how much you can make in various ways, participation rates. You're not getting that. So don't believe it. And that's why I say these are ones to be like a cat. Might be a little bit wary, might get snapped. Not can always trust it. Okay, a MEC. Modified endowment contract. So what this is like the cash value in the life insurance. If you fund it too fast, which is what people like, the whole point of what I was saying earlier, if you had a lot of money and you're looking for a tax haven, this is what people used to do. And then you have this tax-free, tax-deferred growth, and then take a tax-free loan on it or withdrawal. And it's like, yeah, man, free money, and then Congress said, no, wait a second. And so they did this tax reform in 1986. And basically you fund that whole life in policy pretty much within 7 years. It's too fast, and then it becomes a MEC. And once it's a MEC for life. So the LIFO, last in, first out treatment of taxation. So what it means though, if you pull out money from a regular insurance, the cash value, it comes out tax-free until you get to the earnings, which then you pay taxes on. Nope, all of it, because of this, they know you're trying to hide from taxes, basically. So everything that comes out first is taxed. So it's last in, first out. So you get taxed on the money right away, and you can't change that. You still get the death benefit, but if you're taking a loan on it, it's going to be costly, and it can't change for the life of the policy. So that's something the insurance agent needs to make sure you're not do, you don't fund it too quickly if you actually did that. This is another important thing, is the unholy trinity, how to screw up tax-free as well. And this would be an insurance policy where the policy owner is one parent. You see on the bottom left, the person that's insured. So let's say the person insured is the dad, the policy owner is the mom, and then the dad passes away and mom gives deems the gift to the child. Nope, that's not. So that doesn't work. That person gets taxed on that. It's considered a gift then, not insurance. So don't ever set up this trinity. The insurance owner, insured, and the policy owner should be the same person to avoid that. And that way that the death benefit is tax-free. Otherwise, it's like a gift that gets taxed. Any questions on this? Okay. Bigger words. Risk-free guarantee. These are the things that I've typically heard, and probably everybody in the military has probably heard this at some point when they were young. Yeah, and some salesman was trying to come to them, leaving a legacy. And I believe in leaving a legacy, but at the same time, what I want people to realize is, and I've asked these questions before, I should have waited, but 80% of millionaires are self-made, meaning they've never gotten an inheritance greater than 10K, or they're already millionaires before that. And the reality is, the later generations just waste your wealth. 70% of wealth is lost in the next generation. 90% by the grandchildren. And too much I think of that is, I remember seeing in COVID some young 18-year-old with like a 150K Mercedes. I mean, it was beautiful, but I was like, and I could tell it was his car. And it's like, I couldn't help but ask, like, hey, is that your car? And he's like, yep. I'm like, just curious, how do you afford it? He's like, my parents love me very much. And I was immediately thinking, no, they don't. Sorry. But it was like, how do you go from that to a used Civic? Like the lifestyle, that's why this wealth is lost, because we don't teach, and that's a tough thing. If you're doing well, how do you teach for scarcity? And, so that's a challenge for being successful, but you got to do it. You've got to teach your kids still financial responsibility. So, and then here's the other trigger word, super Roth, or, they always talk about tax-free, taking these loans. It ignores the step up in basis. They don't even talk about Roth accounts, probably because they don't even know about it typically. And there is, like I mentioned yesterday in the discussion, the mega backdoor Roth. And by the way, we're getting that through at Viasat next year. And so that's a way to use after-tax contributions and in-service distributions to, once you have maxed out your 401k contributions and you have additional, you can contribute up to the $69,000 current amount allowed under the 401k umbrella. We can go into that more if you want, but and you'll notice this whenever the market goes down. The market, and it always, it's up 75 to 80% of the time, but then it goes, and it scares people, understandably. Watch it though. Those bear markets are a breeding ground for high commission annuities and insurance.
Hey, Alan, I don't want to derail you. Do you have a portion later on for life insurance for our kids? Is that included in this?
I didn't have just on it. No.
Okay.
In general, I don't see why you want that. What I would do. Yeah, I'll get some stuff together for that, Kyle, but I don't have that specifically on here.
Okay. No, that's fine. Yeah, we can talk about it.
I know I'm a bigger fan of, and especially if kids are working, you can do custodial Roth and get them investing right, early on. And, there's other things in other accounts, which that's a questionable one, because speaking of like, how comfortable are you with your kid having a lot of money at 18? whereas I don't mind, index funds will cost a lot. You can fund a separate brokerage account, where, you're going to pay a little bit of tax. It's not, to me, it's not everything's about 100% optimization. It's for flexibility and what's best for your life.
Yeah.
So like I've got a niece
Okay.
accounts that I'm going to give to them when the oldest turns 25. That's my plan. You know what I mean? And that they're a little wiser, a little older, and less likely to just blow that money.
Okay.
But but if you could get them started, if they have like babysitting, mowing lawns, whatever, and they got cash, you can open up a custodial Roth and get them started like 10 years old or something. Imagine having a Roth account at that.
Yeah.
Well, yeah, yesterday I was watching a thing and the guy was like, listen, man, the day your kid's born, $7,000 just goes into that account and that's it. That's like literally the only thing you ever need to do.
Yeah. That you can't do that in a Roth account because that needs to be earned income for that individual.
Right, but in an index
but
fund,
just in yeah, exactly. Put a brokerage account. Yep. No, exactly. That's it's amazing. Okay. Here's, if you have an whole life policy, that's something. Don't be careful. Don't just go make like, oh, I don't like whole life now. Something to really consider, and that's something. This is a friend of mine. She was in some classes. She knows insurance a lot better than I do. I know investments and stuff a lot more. But she would actually be able to help. But make sure you talk to somebody. Don't just make a sudden movement like this. Here's finding insurance. The importance of insurance. Like when you think of, I know some people just try to find the cheapest homeowners insurance, and like auto insurance. You want it to be there when you need it. So make sure it's rated, high. And then here's some things like we were talking about, Kyle, to different ways to get for different types of insurance for getting quotes. Use USA. They're good. They're maybe not the cheapest, but you got coverage here, and they've always been great whenever any issues with auto, always done well. Okay, and then this, probably can barely even read this, but this covers, if you guys want to pull these slides down later, all the differences between the things we talked about: term life, whole life, universal life, variable life, and variable universal life. Okay. Yep, so we covered that. These are the other topics we'll be covering on the veteran-specific quarterly topics. So we'll see. It'll probably do either the financial fringe benefits of non-retiree veterans and retirees, or maybe do reserve duty, since that's one that's kind of confusing. I think get the points and figuring that out, and what would be your pension, etc. And then these are other topics. So speaking of how, the next one is investing for children. So that's something we want to do. The next one I'm prepping though is really estate planning, because that's one that is too overlooked and it's too important not to be taken care of. So that's the next one I'm really working for our next new one. Okay. We didn't talk about, let me switch quickly. We'll go past. Okay, here's, like I said, this is a net worth tracker. I have it broken out into cash equivalents, taxable investments, like a brokerage account, Roth, so tax-free, traditional, which is, tax deferred, and then some other things, and then homes, etc. And then it breaks down into what's your, in a pie chart, how much of your, and this, I just threw these numbers up, they're not mine, these are just made up. But, and then I also, like, to me, your whole net worth is something, but real estate is illiquid. So I like what are my FI financial, what's my liquid financial, what I think of financial independence assets, what are all of my accounts, the Roth and, taxable retirement accounts. And then this will change. You can see how this changes monthly and quarterly. So which is kind of, it's good to see as it's building. Like I said, I think it helps promote good behavior. Okay, let's go to quickly to umbrella policy. It's called a PLUP, personal liability umbrella insurance. By the way, it's personal. If you have a business, you need separate umbrella insurance to cover your business, and like errors and omissions, insurance for certain things. But this is, like I said, it's like $150 to $300 per year for $1 million in coverage, and similar for going up even less. That for $2 million, it's not a $600. It's so affordable. It's just silly not to have it, and especially in our litigious society where people will sue as much as they can. What it does though is it requires your liability limits above the state limits. Those liability limits by the state are so low. I mean, it's ridiculous. The 15,000, 30,000, and 5,000. That's not going to cover anything really if somebody gets hurt in an accident. You know what I mean? Like, think about medical bills. So what this does, the umbrella, like with USA, it brings up your minimums to 300K, 500K, and 100K. It barely changes your auto policy. Yes, you'll have a little bit of an increase on your auto insurance, but it's completely insignificant. And then renters, homeowners and renters have the minimum there as well. But here we'll go through some couple examples. And when you get it through the insurance, they will force you to, update up your limits on your other. But you could go back and lower those later probably and try to be sneaky, which would be stupid. But so we'll go through it. Here's somebody has $1 million umbrella policy. They got the auto, 300K per person as required. They get in an accident and $750,000 suit against them. Insurance pays that first 300K. Then the umbrella covers the 450K. Bam, nothing comes out of John Doe's pocket. Now, what if you then tried to change your coverage back to the California minimums or what state minimums? Okay, so you got the initially auto minimum at 300K, but then you skimp and go back to 500K. Well, you get in that same accident, $750,000 suit. Auto insurance pays 15K. Umbrella policy covers the 400K because it covers what's above what they said you needed as a minimum for the auto. So Jack has to pay the $285,000 out of pocket. Don't do that. But get insurance. Get the umbrella insurance right away. If not, accidents happen. Make sure you're protected. Okay, we'll go back to any other topics you guys want to quickly go through, or is that?
Hey, Alan, have you done a high yield savings topic?
I haven't. I could. I mean, I'm a big fan of having a high yield savings account for your emergency fund, or you could keep that in a brokerage account, just in a money market. But you want cash to put that's where I'm a fan of Ally. There's several good ones, but what I like about Ally is in one account you've got 10 different buckets you can create. So you can fund. You can have a vacation fund. You can have a home repair fund. You can have a Christmas, whatever, birthdays, gifts fund. All these different funds that you can, and it's all, you could just, when you deposit money into it, it'll go, in however you set it up, money coming in, it goes into these buckets in whatever order. So I really like that. And it's like, the good ones are all about, they're pretty competitive. It's probably like 4.3 to 4.5% right now. So, it's a decent return, and that's for everything. So these don't get sold on these ones that go, 5.5% on your first $1,000.
I'm just curious about CDs and treasury bills.
You'll get better returns on the CD, little bit on CDs and more on treasury bills. like right now you can get, I just looked, you had like a 5.39 on a like a 3-month treasury bill, but you need to hold, that's not liquid right now then. So you want, if you have an emergency fund, Dustin, you want that liquid to where you don't have to sell. So you could put some money into, like laddering it. So, okay, I won't need, let's say you have a 6-month emergency fund. You need 3 months like liquid, like cash, in that high yield savings account. Then you could have the rest, more 3 months in a treasury bill, because that's gonna become liquid in 3 months, and you've made a little higher return. You can do that, and that's how down the road, like with bond ladders, you can do as you're getting close, you're in retirement, you can have these bond ladders that go off every year, where you've got income coming in, but you're making a better return than you would on cash equivalents. But that's a little beyond the scope of this right now. But Dustin, does that, you have any questions on that? I'm sorry, I kind of went through that pretty quick.
Yeah, well, I could talk to you offline about.
Okay. Here, you guys, this is what it said your guys' homework is. The net worth tracker is on the website for a free download if you want, and it's got instructions. But take a look, how much life insurance you need. The first thing is get that umbrella policy, get that in place. Don't hesitate on that. And then one of these things, if you don't, I always like to, every year verify the beneficiaries for all your accounts. Just something wise to do, because that's, even if you have a trust or anything else, the beneficiaries on all these accounts are the first thing. They're hierarchy above everything else. So you got to make sure those are correct. You think about people going through divorce or other things, I've heard some horror stories of the ex getting everything just because they didn't review these. We're in the open enrollment right now, so you have to go and do it. It's not going to roll over. So go do the Alex thing and walk through the questionnaire. Figure out your flexible spending account need, because that's something, how much are you going to come out of pocket? That's use it or lose it. So you don't max that out if you're not going to spend that much money. But if you are, use it. That's tax-free money. You're saving a high percentage just by that. And you can use it immediately. Like I got the Invisalign thing last year, and that's a big expense right out of the gate. Even though it takes out paycheck per paycheck, you can use that whole FSA money that first month when it starts. So it doesn't have to build up, it just comes out of your paycheck. But it's like, you can use that credit card and for the total amount that you plan for that year. Anything else? You've still got 1 month to the day to fund 2023 IRA. $6,500 for people under 50. People, the year you turn 50, last year, you could fund another 1,000 to 7,500. So if you haven't finished your IRA contribution for 2023, when you go in, make sure you select 2023 before tax day, because it'll give you that option until tax day, and then you've got until tax day next year to fund 2024.
So quick question there. So you have till April 15th, right? To fund. Okay. And then let's say you didn't max it out. That's okay, right? Like,
it's okay. It's just, it closes. The window closes.
You've
lost that chance to invest that tax-free growth money forever.
Right.
So,
but for that year. Okay.
For that year.
Okay.
Exactly.
Okay.
Yeah. And that's why I said until tax day, go in. If you haven't fully funded 2023, make sure when you select the year, you select 2023, not accidentally 2024. You know what I mean? Since you have another year to fund that money. Makes sense.
So you can just take it out whenever.
You can't, contributions you can take out, not a backdoor, but you don't want to do that, Mike. Like, yes, you can.
But it's like, if you're deciding between putting,
like
if you're deciding 4,000 or 6,000, you might as well put 6,000 in. If you really need, take 2,000 out.
you could. And ultimately what
you
want to
shouldn't
do is you should have an emergency fund already to where you have that cash if you need it. And then hopefully you can fund. But yeah, you're right. I would put I would put the whole 6,000 in, and I would figure out the 2,000 somehow.
Yeah. I have a question about the HSA.
Yep.
Real quick. It's more of something I noticed. So this is the second time this has happened. Our HSA
Okay.
through Anthem, they have some brokerage in the back, and
Okay.
they switched it or something, and then they cashed out all of my investments. And I believe they sent me like a random email at some point, but I didn't notice. So this is the second time that's happened to me. So I just wanted to, I guess,
And
let
it
people
just
know.
sits there in cash.
Yeah.
Wow. That's something I would have you
So
hit up,
check up on your
have you hit up,
HSAs.
yeah, yeah, everybody, if you have HSAs, make sure it's invested, because that's the whole point of it, is investing that money and then letting it compound and reimbursing yourself down the road for medical expenses. The Mike, did you hit up benefits about that?
No, I didn't.
Definitely do that, because they need to be aware. I'm sure they're not.
Oh,
You know, well, they may be aware, but that's ridiculous, and they should be informing us if
yeah, it's definitely not like made known
yeah,
enough because I
exactly.
missed it.
So,
But
no,
yeah,
That's only for your HSA, right, Mike?
yeah, that's HSA.
Yeah, that's not like the 401k or anything like that. I mean, so okay, what other questions do you guys have?
I'm good. This was great.
Good.
I'm gonna play around with that net worth calculator now.
Cool. Excellent. Yeah, like I said, I like to do it quarterly. I think anything in excess of quarterly, like monthly, is just too much. Like, what's the point? But quarterly is good. A lot of people just do annual, which is also good. But I like to keep a little more track on that. You know, so
Actually, Empower has a nice calculator built into it, like a net worth aggregator.
Mm-hmm. Yeah, that's more of a recent thing, actually. So that is pretty good. But I like to do my own. And then, like, personally, this is something I don't update my home with the market value. Because I want to see how my net worth changes based on what. So I guess I do too, but I want to see how my net worth changes based on my actions, my investments, my paying off the mortgage. You know what I mean? And if I put money into the house, like doing remodels, yeah, I'll put that money, I'll up the value to a certain, probably 70% of that, because it's not going to be 100%, but I'll increase that value based on the remodel, but not on the market, because I want to see what I'm doing, my behavior, and how that's changing my net worth. And then separately, though, for the umbrella policy, I would do the actual home value, because your real net worth is higher. So sorry, that was kind of a lot of words at the last, but hopefully that if you have any questions, you guys have any questions about that. But I like to, like I said, I don't like to change my mortgage with the whatever the market's doing in the housing market. Keep it at what I paid plus remodels, and then that gives me overall, this gives me an idea of how my behavior is updating my changing my net worth. Cool. Okay.
Sounds good.
Well,
Thanks,
great.
Alan.
Well, I'll stop sharing. Yep, you're welcome.
Thanks, Alan.
Yeah. Yep, you're welcome.
Yeah, thanks, Alan.
Thank
There
you.
you go.
Absolutely. Thank you. You guys everybody have a good weekend, and we'll see you soon. I'll try to get a state plan for in a month. Get one of the discussions on that, but that's extremely important, and probably the most overlooked thing, I think, in general. So cool. And see where stuff.